Welcome to Markets Now. I'm Michelle Rook along with Darin Newsom, Senior Market Analyst with Barchart. And we're seeing a lot of green on the board here this morning. And Darin, let's talk about soybeans and meal being up. We did have some frost in Argentina over the weekend, and so that's kind of pushing the market, but we haven't taken out last week's or last Monday's highs yet.
Yeah, both of those are key points, Michelle. It was a bit of an unexpected frost. Now, reading some of the reports, they weren't expecting it to have done much damage to the Argentine crop, mostly because so much of that crop has already been damaged by drought. So it is interesting to see the overnight reaction. And from a technical point of view, you're absolutely right. May contracts for both soybeans and soybean meal have not taken out last week's highs. Let's see how these markets work once we get closer. The other key story, weather-related story coming out of South America, was it continues to rain across central Brazil, and so we're seeing some commercial buying in soybeans. We've got May gaining on July. March is pretty much off to the side now as it gets ready for delivery. So we're watching that May-July spread, and we're seeing May continue to gain on July, telling us that world's largest buyer is still interested in U.S. Soybeans. And as we talk about some other markets, they're interested in them as well.
So when does the weather concerns that we've seen not only in Argentina, but now with Brazil, you mentioned the slow harvest there, the rain up in the northern part of the country, that's also slowing down second crop safrinha corn planting. When does the corn market start recognizing that?
Yeah, corn just loves to go sideways, and that really seems to be what we're caught in right now. If we compare the available stocks to use, not the make-believe ending stocks to use from USDA, but actual available stocks to use using cash markets, the cash national average cash prices, we see the U.S. soybean situation fundamentally is much tighter than what we have in corn. So, I think we're working towards that situation. We've had the March-May corn spread move back to a par. But on the other hand, that May-July spread's gone out to about 11.5-cent inverse, closing in on its recent highs of 13 and 14.25 cents inverse, respectively. So, we are seeing the market react, just not necessarily in the futures market, but certainly in the spreads.
Okay. We're also coming on to the one-year anniversary of the Black Sea War, and we've had some developments geopolitically with Biden visiting Ukraine. Is any of that going to play into putting some premium into the wheat market or other markets this week, do you think, Darin?
Yeah, I guess I call it a little bit differently. I don't necessarily call it the Black Sea War as much as Russia's illegal invasion of a sovereign nation. Okay. But we didn't see much. We didn't see much reaction in Chicago wheat over the last year. We saw a couple of quick spikes and then fall back down. So that was a bit interesting that we didn't see the commercial support come into Chicago. And again, if we talk about spreads, if we look at the Chicago spreads, it's the only one that's bearish. And in the available stocks to use, that's the loosest that there is in the five major U.S. grains. So, at some point, we could still make the argument that the world's going to come knocking on the door, particularly if there's a drought going on in France. But so far, it hasn't happened.
Yeah. So what else are we watching this week from an outside market perspective? We do have, GDP numbers coming up on Thursday. We have PCE on Friday. So, the Dow is down pretty hard today. And is the market already anticipating some negativity out of those reports?
Yeah, it's interesting. We are seeing some pressure in the U.S. stock markets. So it's not overly surprising as we come to the end of the month. All three major markets remain in long-term uptrends, but also in position to pull back for a few months. Some of this is going to be tied to headlines naturally because all the financial networks are, trying to beat the bearish drum as hard as they can. So we are going to see some of that play out. But from pure economic indicators, again, let's go back to the boxed beef market. Let's talk about pork cutout. Everything is showing that consumers are still buying. They're still pushing the markets higher. There's still a lot of demand. So as long as we continue to see that, I think the overall economic situation still looks strong, despite what all the talking heads like to say.
So since you moved over to cattle, let's talk about that. The cattle market, we've seen boxed beef about $19 on the choice off of the February 3rd price. And so, can we keep that going? And will that push cash higher again this week after a higher week last week in the cash?
Yeah, it has been it's been interesting watching the cash cattle market because, historically going back a long ways over the last 20, 30 years, futures, futures have followed cash. But the argument is being made now that cash cattle are actually following futures. And, it's kind of a distorted system because we continue to see futures pushing higher. We just don't see much pressure. We continue to get bearish technical patterns, but they don't mean anything in both live cattle and feeder cattle. So it's going to be interesting again to see how long this sort of environment lasts, where the futures market's staying strong, futures spreads are bearish, and cash continues to move higher. It's a strange combination.
Yeah, and like you say, this market, especially the cattle, I know we're into tight numbers, and so that's helped to support the market. But certainly, all the naysayers about how this market was going to roll over due to the economic concerns, they've been kind of proven wrong here.
Yeah, and let's go back to one of the things you said. We aren't in a tight cattle situation. We can see that in the spreads. I know there's a cattle on feed report coming out, and everybody wants to compare the
Right.
numbers back to last year. That's rather, it's kind of a false sense of security because we're comparing it back to record large numbers. We're not running out of cattle anytime soon. We've still got a lot of cattle in the yard that we have to work through. The big thing is what's going to happen the second half of 2023 when we start to see the effect of those placements that are starting to come down.
Yeah, and I think most everybody's anticipating a pretty bullish cattle on feed report coming up here on Friday. So the cattle market, like I said, live cattle are higher, feeders are lower with the higher corn this morning. Hogs are off to the races. Is that a function of the fact that we have had cutout values starting to advance higher now?
Yeah, I think so. We look for that unseen hand that's helping support, both cattle and hogs. And it certainly looks like it's coming out the back end of the processing plants, boxed beef, pork cutout, again, showing that there's a great deal of demand out there for both products. So, I do believe that's where the support's coming from. We don't see it in spreads, but we can clearly see it in those two markets.
Well, some good advice this morning. Thanks so much for joining us. Darin Newsom, Senior Market Analyst with Barchart, and that is Markets Now.